now when it showed me off earlier when I was speaking outside. I think both guys have discussed two important things, quantitative and qualitative analysis. And this is what I was saying to you earlier. I think one of these guys, they said one thing, and then again, I'm not dissing dApps. I'm not saying that all dApps are not useful, because we've invested in dApps, and I think dApps still have a bit of a room to go as long as the community is using them properly. But it's more about decentralized, it's more about blockchains, it's more about the infrastructure and stuff like that. I think the morning began with those comments. So now I would like to invite our final guest before we break off for lunch from AlphaChain. I'm not sure, Henok. Please, welcome to the stage.
Human after all, you're only human after all. Don't put the blame on me.
Hello, everyone. I'm Henok Tekle. I'm the founder and managing partner of AlphaChain. We're a blockchain advisory and investment firm, and help early stage projects prepare to ICO. We help with the go-to-market strategy, white paper creation, and also bring them investment. I'm going to talk about VC disruption in the age of ICOs and focus on the investment market changes over the past year, and kind of how the use case of tokens has shifted for investors. So by show of hands, how many of you have invested in an ICO? Okay, pretty good number. And how many of you have invested in startups for equity? Okay, a bit less. So for those of you that are more familiar with ICOs, which seems to be more viewed than VC type of investments, this slide shows the differences. On the left, you can see the general criteria of VC investor characteristics, and on the right, you can see the characteristics for ICOs. So with VCs, when you invest in a startup for equity, the founders of that startup dilute some of their ownership. So in exchange for receiving investment, they give up some ownership of the company. And the gamble that the VC is taking is that at some point the startup will mature and hopefully become acquired or ICO, or I'm sorry, IPO, once it's generated enough revenue. And also what you have is accredited investors. So in the United States, these type of investments were only available to accredited investors, which is what a major disruption that ICOs brought to this landscape. And then finally, you have a valuation model that is long established. VCs can generally expect in a liquid investment for many years, oftentimes 6-7 years, if not longer. And there are formulas that they rely upon to kind of model the risk and fundamentals of the startup. With ICOs, as we know, tokens do not confer ownership. There is a kind of regulatory question around whether tokens are securities or utilities. Most projects have tried to kind of structure their token offerings as utilities, that these tokens will have some kind of purpose in the solution that they're building, whereas some take the view that these are actually securities. Most people who invest in ICOs are taking a risk and hoping that they realize some short-term gain. Now, this brings us to kind of where we've seen the market change. If you look at last year, to get into an ICO, all you needed was an email address, and soon in your inbox you'd get an Ether address to send your funds to take part. There was no KYC. The project didn't need to know your actual identity, and that has changed dramatically in the past year. So compliance and regulatory influence has really accelerated in the past year to where For Americans especially, crowd sales have pretty much vanished. It's kind of gone back to the old VC style of the well-connected and more active investors getting access to private sales, pre-sales, and projects preferring to either airdrop tokens, to create the network effects, or to just have them list on the exchanges for the broader public to take part. The second point could be almost anyone in many cases. That's also changed. So last year, when ICOs went viral, pretty much anyone anywhere in the world could be an investor in a project at an early stage. Now it's kind of gone to accredited investors in many countries, and in some countries it can be anyone still, but that also kind of seems to be in limbo. And then finally, what really made ICOs a game changer, a true disruptor, is the fast liquidity. And this is kind of where you kind of see the disruption of venture capital, where you don't have to be tied to this project for many years before you see an exit. There is an active secondary market where these tokens are tradable. It can be as early as the day after the ICO, up to a couple months generally. And there is a market. There is a lot of manipulation in the fact that these exchanges are not regulated, for the most part. So what you often have are market makers that run algorithmic bots. What they do is reduce the bid and the ask spread on the order books, and then which is legal. I mean, in traditional markets, market making is legal, but you also have wash trading, which is where bots go beyond just tightening the spread and actually trade directly with one another and really pump up the price, which is illegal in traditional markets. But for now, in crypto, this is just kind of a shady thing that is not regulated. So what we've seen is many projects have tremendous price action on the tokens in a very short period of time. You've probably heard of some that have done, 100x ROI multiples in a span of months, and that's kind of what's brought in a lot of speculators into the space as investors. So the investment characteristics, they're pretty similar when it comes to disruptive ideas. With startups, Silicon Valley being kind of the hotbed of entrepreneurial startup entrepreneurs, you kind of have generally young people, very competitive, coming to a place where there's a culture of venture capital, of investors that are willing to fund ideas in exchange for ownership. And this is kind of how we get, projects like or companies like Uber and Facebook and things that kind of change the world. So it's kind of the same thing with the blockchain. As many of you know, blockchain technology has the potential to disrupt virtually any sector where you have a third party providing kind of a useless and even risky middleman function in a transaction between two entities. So with smart contracts, if you can build a secure base layer on the blockchain and scale this technology, you can potentially unleash tremendous liquidity by removing any third party from a transaction. Scalability, very similar. The idea is once the technology allows these decentralized apps to deliver solutions at scale, you can pretty much address a mainstream, broad public and increase adoption. And it's the same idea around venture capital. When you invest in a startup, you're hoping that through providing these companies funding, that you can acquire talent and users to this product and eventually gain mainstream adoption. The team, advisors, use case, very similar. In the case of ICOs, there's a lot more due diligence needed around, the teams. And, what you had last year was a situation where pretty much anyone with a white paper could raise a tremendous amount of money that you would never be able to get in VC in most instances. And that's kind of where the risk is. With right now not having a valuation model, a lot of this dependent on speculation, people tend to overlook the teams and the advisors, or even know exactly what advisors are doing on many projects. Whereas with venture capital, with startups, it's a lot more clear-cut and transparent. So when it comes to the projects and the companies, in VC, it's about users, right? So anyone that creates an app for a startup can acquire users. Once you have users, you have a market essentially, and you can take investment from advertisers. You can create other solutions and grow this market of users and scale. With ICOs, this is a little bit different. So what matters mostly around these tokens is network effects, because what we've done now with technology is move from closed source to open source. So with open source technology, which has traditionally been underfunded, you need what are called network effects, because potentially anyone can take code and just copy whatever someone else did and maybe fork it or make some kind of variation to market a different kind of product. What matters mostly is the network effects, so the size of the community, their engagement. If you look at Bitcoin, for example, there is no known leader. They don't have a staff, a sales team, a marketing team. The technology in its current state is not scalable. And then you have a governance problem with, how do you scale it and bring on more applications to do great things with this technology? But it doesn't matter because it has the network effects. So people keep talking Bitcoin, 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 and it's generally the first cryptocurrency that people know about when they understand this technology. And in many parts of the world where people are looking for an alternative store of value, Bitcoin is going to be their go-to crypto. So that illustrates the power of network effects. And then the valuation model, as I mentioned with venture capital, it's pretty established. It's kind of been in existence for many years. VCs have had to learn the hard way over decades, kind of what criteria is important for valuing a company at a very early stage. And many times they often get it wrong. Even with a lot of experience, a lot of history, oftentimes many of these investments still fail. With ICOs, a lot of valuation. There isn't really a valuation model yet that is widely understood and established. But what we do have is something called tokenomics. So projects decide, developers essentially, how many tokens they create for this project, and then the project also has to decide how much of that token supply do you give to the public in your offering. And then also, how much money do you want to raise in your offering? For speculators, investors, what they want is a project that has a good amount of hype, community engagement, a lot of interest, a lot of traction, and then a valuation that is relatively low. So, you probably heard of some projects last year looking to raise $100 million, just absurd sums of money. If you have a valuation that is, let's say $20 million or less, and it's a very widely hyped project and there's scarcity around access to the offering, then what that means is you have excess network value that the team isn't taking for themselves. And what happens is that spills over into the exchanges, and that excess value is what oftentimes leads to price action. So for speculators that are looking for a fast return, the valuation of the tokens are really important. So strategy, it's very, very different. VCs tend to make a tiny amount of portfolio additions every year, very hands-on. They like to have the ability to control management and have influence over decisions of the teams as they begin development. With ICOs, you have a lot of folks that are speculators. They're looking for immediate arbitrage. They want to make life-changing money, and this is the Wild West right now, so that's what's drawing a lot of interest in this space. Long term, I think many of these utility projects are going to die, especially those that are based on decentralized apps, because the state of the technology right now is just extremely early. So if you look at Ethereum, which has the largest developer community, probably 50,000 developers, some of the smartest people out there, the transaction throughput right now is still 15 transactions per second. So what Ethereum is working on is establishing a very secure base layer, and a lot of these experimental blockchains for scalability, interoperability. This is something that can be incorporated into Ethereum through what are known as side chains. So long term, a lot of these projects that are built on ideas that are hoping to acquire users, we're very far away from having users for decentralized apps. It's going to take many years to get this technology in a place where it can support an economy based on decentralized apps. So for most people right now, at least, when it comes to long term, they're looking at Bitcoin because soon enough, institutional investors are going to start putting money into cryptocurrency. You may have heard that Goldman Sachs recently announced that they'll be using their own money to launch a trading desk. So where you have that money pouring into is going to be the cryptocurrencies that have most of the market cap, which is Bitcoin. So if you look at all these alternative cryptocurrencies, when you want to make a trade, the pair that has the most volume is Bitcoin. And then OTC, of course. So a lot of trading activity is actually not on exchanges. It's through these over-the-counter providers. And Bitcoin is by far the lion's share of that activity. So long term, if you're looking a few years ahead, Bitcoin is still likely to be, the leading cryptocurrency in market cap. But then you also have Ethereum, which is already extremely popular because it created the ERC20 token standard, which allowed anyone basically to create a token. Tells you how to create a token. ICOs then started multiplying daily, building on Ethereum and issuing out those tokens. And then also CryptoKitties, which was a hobby that people took part in, breeding digital or virtual cats and trading them. That also became very popular, and that showed that Ethereum has the potential to introduce projects and applications that can gain mainstream adoption. So another strategy is around diversification of investment. So what VCs generally do is write a bunch of small checks. So if you look at a lot of the early investors, for example, in Twitter and Uber, Chris Sacca was one of the most prominent VCs. He's a billionaire. He wrote a $25,000 check at the time, which turned out to be extremely lucrative over many years. And then what they do is they monitor what companies are doing well. Later rounds of financing, they start to double down and really make some conviction bets on the ones that they think are going to do well and go public or become acquired. With ICOs, what you have is it depends on the risk profile of the speculator. In most cases, you have what are known as whales, so people that have a lot of disposable income and they want to see a large return. It takes money to make money kind of mindset. You'll see them making high conviction bets in fewer projects, and then you have folks that kind of scatter their investments around, hoping that one or more of them will see a fantastic return in a short time. And then also syndicate pools. So for many people to take part in private sales, oftentimes these projects have a minimum investment amount that they require. So it could be $100,000, $500,000, so on and so forth. Now, for many reasons, people decide to form syndicates where they reduce their exposure and they also can take part in investments that they wouldn't have the ability to on their own. So that's also been something that is very popular. It's starting to come down in the space as we've seen a lot more interest in projects returning to lower valuations. They're very selective of who they let get access to their private sales. So they would prefer that you have a fund or someone who's value add, someone who can help the project grow, because right now the noise to signal ratio is super high. There's always ICOs coming out every single day, and they have to be more selective. So what you're seeing is a reluctance from a lot of projects to take money from syndicates, because a lot of times these are investors or speculators that don't have the project's interest in mind. They just are looking mostly for an arbitrage opportunity in the short term. So funding, this is kind of where things are extremely different between venture capital and ICOs. Historically, only very well-connected, rich, wealthy people had access to a lot of the exciting startups, like Uber or Twitter or things of that nature. Very, very small circle of insiders. With ICOs, obviously, this has disrupted the way early projects can raise funding. It's expanded the pool of investors to just about anyone. And as I've mentioned, that's starting to change. We're starting to go back to the old VC way of doing things with these private sales. Liquidity, very controlled invest and exit times. If it's a VC firm, oftentimes investors have a board or a group of investors that they have to make decisions with, challenge their ideas. With ICOs, obviously these tokens, with these very active secondary markets, you can simply go out and put out a sell order, and once that's met, you've exited, typically into Bitcoin or Ether. Valuation, kind of mentioned that it's based on established models in the case of venture capital. In the case of ICOs, it's the team that decides, usually the developers. And pricing, when you have startups or early companies mature enough to where they're at a point where they can do an initial public offering and be listed in the stock market, this is something that investment bankers, companies like Goldman Sachs, help with. With ICOs, again, it's arbitrarily set by the team. So, they decide how many tokens they want to issue, how much they want to raise. That establishes the price per token. And then when they make their offering, they decide what rate if they're taking Ether, what dollar value they're going to assign to Ether at the time of the offering. So this is all pretty much arbitrarily set by the team. And then the trading price, a share of stock, there's a market that determines the value of that stock, which is in essence a reflection of the company for many investors. With the ICO, once these tokens are tradable on exchanges, again, you have a lot of manipulation with the market making, wash trading. You also have the community. It's really important that projects stay engaged after they've done the ICO, because what induces people to start trading is announcements. So, whether they've made a new partnership, whether they've executed on a milestone in the roadmap, it's important that they make these announcements, and in the event that they use market makers to kind of coordinate a strategy around how to make the most of that service. So governance, this is also a huge difference between venture capital and cryptocurrencies. With venture capital, investors try to protect their interest with board seats, liquidation preferences, et cetera. It's extremely hierarchical. It's consensus driven. There's a lot of checks and balances against individual actors, and very politicized. With cryptocurrencies, when you have an ICO, it's typically decentralized. The monetary policy, there's scarcity. There's only a certain amount of tokens that will ever be created, and also how the token behaves. What's its utility in the actual solution? How does it? What are the mechanics? So that's very different. And governance is still a problem that is going to be around for quite some time. There hasn't really been a project yet that has established a scalable governance model. Even with Ethereum, if you look at the co-founders, there's often a lot of different competing visions for kind of how do you make decisions, at scale, and even things around the supply. Like Ethereum right now is not capped, so you can continuously mine it. Should there be a cap? So recently, Vitalik Buterin said, he thinks that would be a good idea. He would prefer some other project create a stable coin that then could be used for projects to raise funds rather than Ether. So, you can kind of separate Ethereum from the whole ICO side of the space. So that's something that is going to be a problem for some time. As we know with Bitcoin, the governance model is one in which anytime if miners disagree, they can fork the code and create a new cryptocurrency, like you see with Bitcoin Cash. Also, we have regulation. Pretty well known and established in venture capital. It's something that's evolved over time, over many decades. With cryptocurrency, with ICOs, it's very unclear. I think the agency that comes to mind for most people is the SEC, just because the U.S. government is extremely influential in the world, and they have what's called long-arm jurisdiction. So if there's any project that sells to a single American, potentially they can be under jurisdiction of the SEC. So what you had is many projects, since ICOs began, simply barring Americans from taking part. And so far, what we've seen is they've issued subpoenas, they've gone after the obvious scams, but they really haven't been making enforcement action on any projects that, so far haven't raised any red flags. There's a question around whether the the offering of Ethereum during its crowd sale was a securities offering, but it's not a clear-cut case. And what you've seen historically is they need something that's kind of airtight before they, make a big splash and start, going after projects. And I don't think they have that yet. So that they're kind of working to see, what kind of strong case they can build, so that they don't embarrass themselves when they actually go out to the courts and start going after people. But everyone agrees that regulation is going to come to this space. It's not a matter of if, but when. And right now, this is something that fuels a lot of the speculative value around these ICOs, because when you have that uncertainty, there's a lot of asymmetrical information, and that's how a lot of people are able to make money. So the conclusions are the potential for some disruption, as it already exceeds other types of funding, and it's growing. So we saw that ICOs last year had already outpaced early stage seed funding for startups. So now we're starting to see a lot more interest of established funds and players moving into this space and taking part in these early private sales, and accepting that they're only going to be getting tokens, oftentimes deeply discounted from the public price, and no equity. So that could be an evolution that actually stays. And it's now about how do we come up with a valuation model that actually makes sense and can bring traditional investment into this space. Also, acceleration of innovation, because funding will be more widespread. So this has also really changed the dynamic where before, you had a lot of investment centralized in places like Silicon Valley. Now that's been kind of disrupted, it's dispersed. So entrepreneurs anywhere in the world can work on projects and raise capital from many people in many parts of the world. And it'll be interesting to see kind of how that affects the established centers of investment and innovation like San Francisco or Berlin. And then non-traditional teams get funded. So this is kind of along the same lines. There's a lot of people that would never fit the profile of getting investment from venture capital. Now they're able to build on open source platforms and receive funding because now there's going to be more capital flowing into open source projects. So that's all. Thank you.
Thank you.
Blame on